Welcome to the Business of Property podcast. I'm Simon.
And I'm Stuart.
We talk every week about the reality of running property businesses. Stuart runs a portfolio of co-living properties with a six-figure turnover.
And Simon owns BTLs and created Patma, a leading portfolio management system and a source of property market insights.
Don't forget, you can join our email list through the link in the show notes. Now, today we thought we'd discuss a topic that someone else mentioned to me. So this is another landlord, and they're in the situation that they have a couple of existing buy-to-lets, and they're feeling that they're not sure what to do with them. So I think we'll sort of improve or add to this story as we go along. But one of the first sort of questions they put out was, what would you do if you had a reasonable amount of money to invest and you're interested in property? Because they have traditionally done buy-to-let, but they don't really feel that it's profitable anymore. And I came back to that initially sort of on the profitability point of buy-to-let, because for lots of people and in certain situations, buy-to-let is very much not profitable anymore. And for a lot of people who are in buy-to-let already, they're going to be finding problems at the moment, especially if they're coming up to mortgage renewals. However, if you're going into fresh buy-to-let deals, I believe it is possible to find buy-to-let deals that are profitable. The level of profitability might vary, and whether you're wanting to accept that level of profitability, that sort of level of return on your money, can obviously vary depending on your situation. But buy-to-let is very low effort compared to some of the other options. Possibly not compared to other investment options, but other property options. So, first of all, Stuart, do you think I'm sort of right in this sort of summary? I know we've talked about this in a bit more detail in a past episode, but just a quick sort of recap on this point. Do you think I'm right that buy-to-let can still be profitable, or am I barking up the wrong tree with it?
Well, as you know, this subject sort of leans into one of my pet subjects that makes me smile wryly, which is people randomly posting questions on the internet or on social media. And I don't think that they're necessarily looking for specific answers. I actually think they're probably just looking to bolster their own personal perspective. So I say a lot of this with tongue in cheek, but it's always interesting to me. And I see it on a couple of the forums as well, where someone says, I've got £100,000 to spend. Where should I spend it? And then that leads to the number of people responding and giving their points of view about where to spend. And I just think, if you've got $100,000, are you going to let a random stranger on the internet tell you where to spend that money? So I always treat these things with a little bit of a distance and a pinch of salt. But of course, the question is, and it's impossible to answer all of these questions as well without the detail from each of the individuals, which is why, again, I always smile wryly. But in terms of profitability, as we've talked about this on this podcast in quite recent episodes, and we know that buy-to-let is really, really tough right now, and the interest rates have climbed a lot. We had a chat with Simon Glastonbury, our mortgage broker, only very recently, so we know things have calmed down a bit, but it's still a lot tougher. And the first question that always springs to my mind is, how are people buying? Are they buying in, so if someone's thinking about investing, are you buying in a limited company or a personal company? Because that is the first question, which, again, we talked about this episode 189, how Simon and I pay ourselves from limited companies. And also episode 178, we talked about, have interest rates broken buy-to-let, for example. If the person is buying in a personal name, then the next question is, well, are you a higher rate taxpayer or a lower rate taxpayer? Because once again, that is going to have a significant issue. And of course, all of that is by the by, depending on the property itself. If you've got a property that's generating £400 gross rental income, that's going to be very different to if you're renting out a property that's generating £2,500 per month rental income. So I guess my response to any of these questions, Simon, is a lot more questions. A lot more questions.
Well, yeah, it's great. But I think, first of all, I'm just going to put in a bit of a defense of people asking questions on social media and other channels and things. As much as I don't think, well, maybe some of them are actually just looking for people to tell them what to do. But I think mostly people asking these sorts of questions are not expecting a "you must do this" kind of answer. They're looking for sort of canvassing opinions and looking for new ideas and trying to find things that perhaps they haven't thought about, or, as you say, perhaps trying to sort of reassure them that their existing plans, their existing thoughts are sensible and reasonable. And I don't think that's a bad thing. I mean, we talk to each other, we explore ideas and thoughts and possible approaches to things, and I think it's the same thing in social media, except you're talking to strangers rather than people you know, which is perhaps a little bit of a strange take on it. But there you go. So, and in actual fact, in some social media situations where the circles are smaller, you can actually be speaking to people you do know at least to some degree. So just to get in my little defense of strange questions on social media. To get back to investing in buy-to-let, you're quite right. It's that the situation matters a lot. And as you say, personal names versus limited company, huge difference at the moment. And that's down to high interest rates and, of course, the Section 24 tax changes that came in a few years ago. And the other big factor, I think, for buy-to-let investing is how much capital you have to put into a project. It used to be that you could put in 25% and get a 75% loan-to-value mortgage, and that would work for buy-to-let. And I don't think that does now. I mean, that there are some exceptions in certain deals, in certain areas, etc., but generally speaking, that doesn't. And I think a lot of people will look at potential buy-to-let deals and say, oh, I have to put in more than 25%. Well, clearly that doesn't work. But if you look at it and say, I don't mind how much I put in, I have the capital available, if you're lucky enough for that, what are my returns? Then it can still work to some degree. So return on investment levels in sort of the southeast, the investment area that I'm most familiar with, in the old world, you'd put in 25% plus all your upfront costs, stamp duty, refurb, whatever else, and you would probably be hoping to get 3 to 4% return on investment, something in that range. And these days, I think you need to be looking at putting in a much bigger cash investment. So you'd be putting in probably at least 40%, maybe as much as 50% of the purchase price. However, the return on investment you'd be looking at getting would still be around the 3% level. It might be slightly less than that, maybe slightly more if you get a better deal, but around 3%. So it's not very different in terms of return on investment. But you do have to put in a whole heap more cash.
Yeah, I think, I mean, as you said, I mean, we've talked a fair amount about this in recent episodes. But my immediate thought is for people with large lumps of cash, that's okay, isn't it? I think a lot of people within the property investing community are not coming in with, large chunks of, hundreds, 100 grand here and 100 grand there. And I think that for 3%, that's then the next question, which we've discussed, and I'm sure we will discuss again, which is property the best place for that money, given all of the things you've got to do for it and the time horizons, versus just opening up a stocks and shares account, throwing it in there and getting on average 7% a year versus everything else that you might be able to do and not have to worry about Michael Gove and the next set of legislation that may or may not come in the next few years. So I think the answer, as always, and you and I think we will repeat this till our dying days, which is if the numbers look good to the person that's investing and you've set your criteria, then do it. And I think a diverse portfolio, meaning both in property and out of properties, is the way to go. I think for a lot of people though, if you've got or actually, what I was going to say is a lot of people won't be coming in with that sort of cash, and I think, as we know, a lot of people are looking to see how they can recycle cash, and I think at the moment that's the challenge. If we think about the greatest aspect, or one of the greatest aspects of property, is the leverage ability. That is getting harder because, like you say, and we've looked at this on the Patma software, and it still surprises me because haven't seen it for 20 years. But if it says that I now have to put 40% or 30% of a deposit on for a deal to look good, to me it doesn't look good. But that is just a case of, because that's not what I'm used to. It doesn't mean that the numbers don't work. It just means that I've not been used to that. I've been used to putting down 15, 20% deposit and then looking at my return on investment based on that. But if you're now looking at 30, 40, 50%, particularly in the Southeast, you're then thinking that's a lot of capital to put into, as we say, an illiquid asset, which you're then going to struggle to get out of, at least for the short term.
Yeah, exactly. And I think if you're going in a very long-term view, you can say that buying now is probably not too bad a time. Prices have dropped a bit. They've definitely come off the peak last year. And maybe they've got a little bit more to fall, but hopefully not too much more. So it is probably not too bad from a capital appreciation point of view to buy now. However, one of the real sort of multipliers of capital appreciation is the ability to leverage it. And if you can only leverage at 50% rather than 75-25, then it makes a big difference to those capital returns.
Can I just say that, I mean, you've just touched on something there which it irks me just because of the way it is. But so if we talk about let's just say the 18-year property cycle, which is spoken about, created by Fred Turner, but let's just say that it's 18 to 20 years. The thing that irks me most is that right now, I agree that it looks like we're getting into the better time to buy. But what really frustrates me is I think, but I'm not going to be in the right time to buy because I'm fighting the fires with my current portfolio and the interest rates. And then what makes me really sad, Simon, is that I think, okay, I'm going to make sure I'm ready for the next event. But in 20 years' time, I'm probably going to be ready to pack up and go home and just go and sit on the Costa del Sol, hopefully, if it's not 80 degrees.
Yep, exactly. 20 years ago, in the last crash, of course it wasn't exactly 20 years ago, but around then, 18, 20, whatever. Yeah, I wasn't ready, too busy doing other things. And now this is a time when I'm really into property. This is my potential crash to be making hay with. And yeah, I don't have enough capital. It's like, oh!
Yeah, and it's like, I now have the knowledge that I didn't have previously, but not the finance. And it was ever thus. And there was just one other element on this question that was raised about, there's a question around leasehold and the fact that they might have had to potentially extend the leaseholds on their properties.
Yeah, so I went back to this person and put forward the points that I've just mentioned about maybe buy-to-let is still profitable. And they came back and said, well, maybe, but it's not for me because they've got a couple of properties that need to be remortgaged soon and are coming up for leasehold extensions or needing leasehold extensions. So they'd have to put extra capital in. And they were saying even without putting the extra capital in, which is obviously something they don't particularly want to do if they don't need to, after the remortgages, they would be looking at mortgage payments bigger than their rents. And I mean, that is clearly the definition of unprofitable. So I think it definitely exists. Unprofitable buy-to-let that does not work for people definitely exists. And as I said right near the beginning, it definitely exists for existing setups if you're not careful. But yeah, we're going to talk a bit more about the leasehold extension thing. And this is something that I've never experienced because all of my investment properties and personal properties have always been freehold. So perhaps you could just explain a little bit about how leasehold extensions work, Stuart, because I know you've been through one, at least one.
Well, I'm not sure if my sigh came through on the microphone, but I sighed as Simon was talking about that through. So very, very quickly, obviously, if you buy a leasehold property, you are not the owner of the freehold. You're essentially leasing that element of the freehold for a period of time, which is now typically 99 years, 125 years, sometimes 250 years, or 999. Could be any of the above. Now, typically, when that lease gets down to sort of 80 years or less, and the number that we used to have, and I'm not sure if it's the same now, but basically, if a lease gets down to 70 years, you will find that property is not necessarily unsaleable, but the value of it will drop markedly. Considerably. So the thinking is that essentially when your lease gets down to sort of 80 or under, that you should really be extending that lease so that it's appealing to the next buyer, and you don't have to devalue that property. And that happened on one of ours, and essentially it was the original lease when my wife bought the property was whatever it was, 125, 150 years. It had gotten down to 80-ish, and we had to extend the lease. When you extend the lease, you, as always, you're crossing quite a few palms with a few different pieces of silver. One of those being a solicitor, one of those being the freeholder solicitor. And essentially what they work out is what they think the value of that lease extension is. And in our case, it was a flat in London. The lease extension itself was about 20k. So quite a significant sum of money. However, what that means is that we wouldn't have to accept a 30% or 40% discount on the property price should we sell it. And it's now that we've extended the lease by 100 years, we don't have to worry about it. What that means, obviously, is that if you're thinking about a property, if you're looking at buying a property that is anywhere sort of around 80, 90 years, and you're thinking long term, which obviously we should be, then you need to be thinking about the fact that these sums of money could come in. Now, the interesting thing is with the current markets, this could be a good time to look at lease extensions because property values are flatter. So when people are doing the calculations, when the professionals are doing their calculations, hopefully the projections are a little bit less punchier than they might be. So my view would be, actually, if you've got lease extensions, now might be the right time. Obviously, if you've got the funding and the capital to do it. The other aspect is, and it's quite interesting, we've just been offered the freehold of our property. So just one other note, if you own a leasehold property, if the freeholder wants to sell it, they are legally obliged to offer it to the existing leaseholders first. They have to offer it for a certain period of time, and then the leaseholders get whatever it is, I think 90 days or whatever the number is, to agree or not. That then will throw you into a separate bucket of infighting with said leaseholders, because first of all, someone has to organise this. So in our case, we've got 6 leaseholders. My wife's taken on the baton of trying to get people together. And as you can imagine, you've got a wild and varied bunch of people, some of which are quite responsive, some that just say, it's fine, I will die in this flat without having extended this lease. So anyway, in short, that's lease. But lease does complicate things. And as anyone that's listened to this podcast knows, I'm probably not a fan of lease because I also have a leasehold flat. And the other thing with lease is that you will pay ground rents, you'll pay service charges, because that's where the freeholders make their money. The other sort of fly in the ointment, and I appreciate we're coming towards the end of this podcast, is that with leasehold, you are in other people's hands, but also there is a lot going on in government around leasehold and how that's going to look in the future. For me personally, and Simon and I talked about this before, if you gave me the option to buy a leasehold flat, it would be my last option. However, if I ran the numbers and the numbers looked okay, I'd probably still do it, but it wouldn't be top of my list to do because of the number of complications. But I would never want that to put someone off. I'd say just look at it, and if it looks like it could work. I mean, the flat we've got now, which was the 6-month flip, which we've now owned for nearly 4 years, that is The service charges are quite literally eye-watering. Every quarter those come through. It pains me. So leasehold something to look at. So just in relation back to the question, I can understand why that would concern them. However, my view would be if they've had the finances to extend the lease, they're probably better off doing that, depending on those values, because obviously we don't have enough data. But otherwise, you're going to get potential buyers when they look to exit that will say, well, actually, it's coming very close to whatever 70 years. I'll then want a 10% discount on the property price. So those numbers need to be balanced up quite meticulously to work out whether or not the extension would be better. And if anyone's thinking of holding it long term, extension would be better.
I have questions around share of freehold versus leasehold, and I think perhaps we could get into that on another day, because unfortunately we have run out of time today. Please do leave us a rating in your podcast player of choice. We really would appreciate it. And Stuart and I will look forward to talking to you again next week.